Navigating the world of S corporations offers significant tax advantages, but it also comes with a strict set of rules that, if overlooked, can lead to serious penalties. Many common mistakes revolve around the initial election, ongoing operational compliance, how you compensate yourself, and various tax reporting requirements. One of the most critical errors is missing the filing deadline for Form 2553, which is essential for electing S-Corp status. For existing entities, this form must generally be filed by March 15th to receive S-Corp tax treatment for that year, or within 2 months and 15 days for new entities. Missing this deadline means your S-Corp election will typically be effective for the following tax year, potentially leading to complex and costly delays. Another significant pitfall is neglecting to check the entity's eligibility requirements before filing. S-Corps have strict criteria, including having no more than 100 shareholders and only one class of stock. Shareholders must also be individuals, certain trusts or estates, and all must be U.S. citizens or residents. Violating these rules, such as issuing 2 classes of stock or having a foreign investor, can invalidate or terminate your S-Corp status. Beyond the initial election, ongoing operational compliance is crucial for maintaining S-Corp status and avoiding IRS scrutiny. One common error is failing to maintain proper corporate formalities, such as holding annual shareholder meetings and keeping detailed minutes. Neglecting these formalities can jeopardize the liability protection that corporate status provides. Co-mingling personal and business expenses is a frequent mistake, especially for single-owner S-Corp. The S-Corp must maintain separate bank accounts and meticulous records to differentiate between personal and business finances. Inaccurate or incomplete bookkeeping can also lead to significant problems, making accurate tax reporting difficult. Proper accounting software and detailed records of all financial transactions are essential for accurate reporting and informed decisions. Ignoring state and local tax obligations can also create issues, as requirements vary widely by location. Some states, like California, impose a minimum franchise tax even if the S-Corp has no income, and may require a separate S-Corp election. The way S-Corp owner-employees are compensated is a major area of IRS focus, particularly regarding the reasonable compensation rule. The most significant mistake is not paying a reasonable salary to shareholder employees for services performed. The IRS requires owners to pay themselves a fair market wage before taking distributions, which are subject to payroll taxes. Attempting to minimize payroll taxes by taking an unreasonably low salary and high distributions is a red flag for the IRS. This can lead to reclassification of distributions as wages, resulting in back taxes, penalties, and interest. Closely related is disguising compensation as loans to shareholders without formal loan agreements. Without proper documentation, the IRS can reclassify these as taxable distributions, leading to penalties. Another mistake involves health insurance deductions for shareholder employees who own more than 2% of the company. Health insurance premiums for these shareholders must be included in their W-2 wages, then deducted on their personal tax return if they qualify. Several other tax and reporting errors can lead to compliance issues, impacting your S-Corp status. Failure to track shareholder bases can result in unexpected taxes, especially when taking distributions. Distributions in excess of basis can be considered taxable income, specifically capital gains if not properly tracked. Incorrectly handling business expenses and deductions is another area of concern, often due to poor record keeping. Misclassifying personal expenses as business expenses is a common error that can trigger an audit. Finally, overlooking deadlines and filing requirements for Form 1120S and Schedule K1 for each shareholder is a frequent pitfall. Late filings can result in significant penalties and interest, adding unnecessary financial burden. By understanding and diligently avoiding these common S-Corp mistakes, you can ensure compliance and maximize the benefits of your business structure.